subscribe, and let us get into the video. So, why should you invest in an index fund? 1. Attractive returns. Like all stocks, the S&P 500 will fluctuate. But over time, the index has returned about 10% annually. That doesn't mean index funds make money every year, but over long periods of time, that's been the average return. 2. Diversification. Investors like index funds because they offer immediate diversification. With one purchase, investors can own a wide swath of companies. One share of an index fund based on the S&P 500 provides ownership in hundreds of companies. This ensures that the investor does not have all his eggs in one basket. 3. Lower risk. Because they're diversified, investing in an index fund is lower risk than owning a few individual stocks. That doesn't mean you can't lose money or that they're as safe as a CD, for example, but the index will usually fluctuate a lot less than an individual stock. 4. Low cost. Index funds have a lower operating expenses as compared to other mutual fund schemes. Here, the fund managers do not need to have a separate team of research analysts to carry out an in-depth research of the companies against which a significant amount is spent. In index funds, the manager just needs to replicate the index. Therefore, the expense ratio is lower in case of index funds. 5. Less managerial influence. Since the fund simply follows the movement of the particular index, the manager doesn't have to choose what stocks to invest in. This is a plus point since the manager's own style of investing, which may not be in sync with the market at times, does not creep in. Here are the best index funds to buy for 2022. 1. Fidelity Zero Large Cap Index, FNILX. The Fidelity Zero Large Cap Index Mutual Fund is part of the investment company's foray into mutual funds with no expense ratio, thus its zero moniker. The fund doesn't officially track the S&P 500. Technically, it follows the Fidelity US Large Cap Index, but the difference is academic. The real difference is that investor-friendly Fidelity doesn't have to cough up a licensing fee to use the S&P name, keeping costs lower for investors. Its expense ratio is 0%. That means every $10,000 invested would cost $0 annually. 2. Vanguard S&P 500 EV, VU. As its name suggests, the Vanguard S&P 500 tracks the S&P 500 index, and it's one of the largest funds on the market with hundreds of billions in the fund. This ETF began trading in 2010, and it's backed by Vanguard, one of the powerhouses of the fund industry. Its expense ratio is 0.03%. That means every $10,000 invested would cost $3 annually. 3. SPDR S&P 500 ET Trust, SPY. The SPDR S&P 500 ETF is the granddaddy of ETF, having been founded all the way back in 1993. It helped kick off the wave of ETF investing that has become so popular today. With hundreds of billions in the fund, it's among the most popular ETF. The fund is sponsored by State Street Global Advisors, another heavyweight in the industry, and it tracks the S&P 500. Its expense ratio is 0.09%. That means every $10,000 invested would cost $9 annually. 4. Issues Core S&P 500 EV. The iShares Core S&P 500 ETF is a fund sponsored by one of the largest fund companies, BlackRock. This iShares fund is one of the largest ETF, and like these other large funds, it tracks the S&P 500. With an inception date of 2000, this fund is another long-tenured player that's tracked the index closely over time. Its expense ratio is 0.03%. That means every $10,000 invested would cost $3 annually. 5. Schwab S&P 500 Index Fund, SWPPX. With tens of billions in assets, the Schwab S&P 500 Index Fund is on the smaller side of the heavyweights on this list, but that's not really a concern for investors. This mutual fund has a strong record dating back to 1997, and it's sponsored by Charles Schwab, one of the most respected names in the industry. Schwab is especially noted for its focus on making investor-friendly products, as evidenced by this fund's razor-thin expense ratio. Its expense ratio is 0.02%. That means every $10,000 invested would cost $2 annually. Additionally, here are a few things to consider when investing in index funds. A. Long-run performance. It's important to track the long-term performance of the index fund, ideally at least 5 to 10 years of performance, to see what your potential future returns might be. Each fund may track a different index or do better than another fund, and some indexes do better than others over time. Long-run performance is your best gauge to what you might expect in the future, but it's no guarantee either. B. Expense ratio. This shows what you're paying for the fund's performance on an annual basis. For funds that track the same index, such as the S&P 500, it makes little sense to pay more than you have to. Other index funds may track indexes that have better long-term performance, potentially justifying a higher expense ratio. C. Trading costs. Some brokers offer very attractive prices when you're buying mutual funds, even more so than the same mutual fund company itself. If you're going with an ETF, virtually all major online brokers now allow you to trade without a commission. Also, if you're buying a mutual fund, beware of sales loads or commissions, which can easily cut off 1 or 2% of your money before it is invested. These are easy to avoid by choosing funds carefully, such as those from Vanguard and many others. Fund options. Not all brokers will offer all mutual funds, however. So you'll need to see whether your broker offers a specific fund family. In contrast, ETF are typically available at all brokers because they're all traded on an exchange. D. Fund options. Not all brokers will offer all mutual funds, however. So you'll need to see whether your broker offers a specific fund family. In contrast, ETF are typically available at all brokers because they are all traded on an exchange. E. Convenience. It may be a lot easier to go with a mutual fund that your broker offers on its platform rather than opening a new brokerage account. But going with an ETF instead of a mutual fund may also allow you to sidestep this issue.